plan I presented to you was, you save $2,000 every month, you invested at 8% ROI every year. After 25 years, you're gonna have $1 million. Now the biggest doubt that a lot of you had was, can I really get that 8% ROI every year? And I'll admit, this does make a huge difference. If you got 7% instead of 8%, for example, after 25 years, you'd only have $900,000. If you had 6%, you'd have $800,000. Every 1% difference in your yearly ROI makes you lose $100,000 right here. So how you invest your money is extremely important, and that's going to be the topic of my speech today. The most basic investment you can make is real estate, i.e. buying a house, or you can invest in stocks and bonds. And they both have their own upsides, and depending on your geographical area, you might want to go with different things. There are online calculators available, like for example, New York Times is a really comprehensive calculator, where you put in the price of real estate in your home and also the returns that you expect to get in the stock market, and it tells you whether you should go with buying a house or whether you should be investing the money instead. One rule of thumb is that if the price of the home is more than 20 times the annual rent, if you're renting a house instead, you should consider buying stocks instead of buying a home. There are lots of other factors, of course, financial factors, but these are all different for each person. I would recommend that you take into account your own things. But one misconception a lot of people have is that buying stocks and bonds are extremely risky. Like for example, at the end of my last speech, Jennifer mentioned that she feels very uncomfortable buying stocks and bonds, so she keeps her money in a savings account. And this was something that I really wanted to address today. Depending on how you manage your money and what you invest in, no matter how conservative an investor you are, you can build the right portfolio with a low amount of risk level. For example, in Jennifer's case, she can just buy bonds. Look at how the bond market has performed in the last 10 years. In the stock market, there were lots of ups and downs. In 2008, for example, during the financial crisis, the stock market took a huge plunge. Look at the bond market. It barely budged. Over the last 10 years, if you had invested $100,000, you would have doubled your money in the last 10 years. And it's not really that risky at all. So I highly encourage that no matter how risk averse you are, you can build a portfolio by buying bonds, by buying treasury bills, by buying government bonds, for example, that suits your risk appetite. How about stocks? We all know that stocks can change a whole lot. If you look at 1-year performance, it can go all the way up 50% in 1 year, or it can go down 37%. But if you look at the time horizon, you'll see that as your time horizon keeps on increasing, the stock performance, the variance here keeps on reducing. So if you're looking to retire in the next 5 years, buying stocks may not be a good idea for you. But if you're looking to retire 20, 30 years from now, buying stocks is an excellent idea. As you can see from this graph, you can make a trade-off between what kind of returns you want to get. Do you want to settle for 10%, 11%, 12% returns? And if you want to get more returns, you'll have to take on more risk. And this is the curve that you end up getting. You can choose for yourself which point on this curve you want to be. Do you want to be very safe? Do you want to buy only bonds? Or do you want to, or if you have more time and if you want to take on more risk, you can choose to buy more stocks instead. There's a link here that I can send out to all of you later, which actually has a questionnaire which you can fill out. And it assesses the risk level that you want to take with your investments. And based on that, it recommends to you how much of your portfolio should be in stocks or bonds. So now that hopefully I've convinced all of you to buy something and invest your money, let's get into how you can actually invest your money. The most basic way is picking your own stocks, looking at companies like Intel, Google, and deciding which companies you want to buy. And arguably the most famous person who invests this way is Warren Buffett. He recommends spending 2 hours every week for every stock that you invest in. So if you're going to buy 10 stocks, you would have to spend 20 hours a week. Do you have 20 hours a week to do this? I certainly don't. This is why I don't recommend this approach for an average investor like you or me. Another alternative is that you can buy mutual funds. Now mutual funds are actually really simple. Here's what you do. You get 1,000 other people. All of you pull your money together, hire someone really smart, someone with a Harvard MBA degree, someone who's worked in Wall Street for 10 years, for example, and you pay that person money to manage your investments for you. The other alternative to mutual funds are index funds. Index funds essentially just follow the whole market by essentially buying every company out there in the market. Now you would think that by paying this Harvard MBA guy who's super smart to manage your money for you, you would think that you'd get pretty good returns out of that. You would be very surprised. 80% of actively managed mutual funds lose out to index funds, which is why I personally refuse to buy any actively managed mutual funds. I always buy index funds. There are a number of reasons for this. Index funds have much lower expenses. Why? Because you're not paying someone $1 million every year just to manage your money. It's a very simple index fund. You also get tax benefits because index funds tend to buy a company and they tend to hold the stock for a long period of time. So they end up paying less money in taxes. There's also a really complicated reason called efficient market theory. I really don't have any time at all to get into this, but I highly encourage all of you to read the Wikipedia article about it if you're interested. So now that you know what funds you want to buy, what type of funds you want to buy, how do you actually buy it? I recommend signing up for a discount brokerage like E-Trade. So far, I've been with E-Trade for like 2 years, and I haven't paid them 1 cent in fees. I don't know how they make money, I don't know how they make profit, but frankly, I don't care. They provide me excellent service for no cost at all. When you search for funds you want to buy, search for these specific phrases: no load and no transaction fee. If every time you buy funds, if you're paying even a $5 or $10 transaction fee every time, over the course of your life, over 30 years, it's really going to add up. Search for these no transaction fee funds. Most importantly, when you pick a fund, look for this number called an expense ratio. A mutual fund, for example, will have an expense ratio of about 1.5%, meaning that every year, 1.5% of your investment is going to go towards running the fund itself. With an index fund, this number tends to be about 0.2, 0.3%. And this also varies. Look for index funds that have the lowest possible expense ratio. I also wanted to give you some specific funds I recommend. So let's go over the broad categories of index funds. You have the S&P 500, which is the most common, most popular index. And this basically consists of the 500 largest companies in America. So this is basically Intel, GM, GE, and all those big companies. So for this category, I recommend SVSPX, which is part of E-Trade. Or, yeah, there's another one that you can find in the Intel 401k as well, but I don't have it. And then the other index category that you have is small cap. Small cap index funds are basically all the startups and growth companies out there. These give you better returns, but they also involve more risk. If you're on Intel's 401k, I recommend buying the VSIIX fund. If you're with E-Trade, I recommend buying the NSIDX fund. Mid cap is everything else in between. I recommend the VMCIX, so on. The international index is an index representing all the developed countries outside of America. So this is basically Canada, Europe, Japan, for example. I recommend the International Stock Fund with the Intel 401k or VTMGX for E-Trade. Emerging markets, they're probably the riskiest out of all of these index, but they also give you the best returns. So this is basically India, China, Brazil, all the other emerging markets out there. If you're a conservative investor, if you want to buy bonds, I recommend the VBMFX. It's an index of all the corporate bonds, government bonds out there. There's another shortcut to all of this. Let me go over another thing as well. You want to decide how you want to proportion your money out of all these. So this is something that I roughly recommend. You'd have to find your own balance. If you're a more risky investor, invest more money in emerging markets. If you're a more safe investor, put more of your money in the international index and the S&P 500. But the international index, I would say, you should really be putting as much money here as you do in the American markets. You don't want to have all your money in just American markets alone, because then you're bound to one country. You're not very diversified. The most important thing about being a good investor is discipline. This is really hard because as human beings, we have a natural instinct to be really afraid of losses. People are twice as afraid of making a losses as they look forward to making a gain. To put it another way, people would rather not lose $10 than make $20. Over the long run, this is not the kind of behavior that's going to give you good returns. And this kind of behavior leads to a lot of bad investment strategies. People leave money sitting in a checking account because they're afraid of losing money. People also sell their stocks during tough times because they're so afraid of losing money. But if you look at the long run, you should always be buying during the tough times. You should never be selling. So in order to fight all these things, I highly recommend doing two strategies. Always tell yourself these two things. The right time to buy funds, it has nothing to do with whether the market is going up, whether the market is going down. Don't listen to anything. The right time to buy is when you have money sitting around. Conversely, the right time to sell, it has nothing to do with recessions, nothing to do with boom times. It has nothing to do with whether you made a profit or a loss. The right time to sell is when you need the money. Everything else is total garbage. If you have money sitting around, buy, invest the money. Don't leave it sitting around. If you need the money, sell. It doesn't matter whether the market is high or low. If you need the money, sell the funds. I highly recommend setting up a direct deposit into your investment account, like E-Trade, for example. And every 2 weeks, log into your E-Trade account. No matter what's going on in the news, invest that money. Now let me tell you my personal story. So this was the market back in 2008. You know, this was during the height of the financial meltdown. Everyone was going crazy. People were worried that the world was going to come to an end. You saw that the stock market was crashing in those 3 months. And right there, that's when I joined Intel. That's when I started earning money for the first time in my life. That's when I started to invest my money. And I was scared, you know, I was scared to invest my money, but I forced myself to. I forced myself to invest money, and here's what happened. 3 months later, the market took a huge hit. Now, at this point, I was feeling pretty lousy about myself. You know, as soon as I started investing money for the first time in my life, and making a huge loss. And right at this point, I got my relocation bonus. I had like a few $1,000s sitting around, and I knew that I should be investing it, but I was feeling so scared, you know. I already lost a few $1,000s. Do I really want to dump in all that money right now? I forced myself to. I remember those two things that I told you all just now. The right time to buy is when you have money sitting around. Forget everything else. And here's what ultimately happened in the long run. Guys, I highly recommend to you, follow these good investment strategies, stick to your discipline, and in the long run, you will be very financially secure. Thank you.